and welcome along to the Property Academy podcast by Open Partners. I'm your host, Tim McKnight.
I'm Andrew Nicol.
It's our show. We're talking about the cost to invest in property. How much does it actually cost? And there are three or so hidden costs that you need to know about as well. Now, Andrew, this is going to apply whether people are buying an existing or a new build property, but just quickly explain to us what are the three main costs these people are going to face when they invest in property.
Okay, so your three costs are kind of three categories. So firstly, there's the purchase price, so how much you're going to pay for a property, and that's going to depend a little bit on where you're buying and the type of property you're buying. Are you buying a townhouse? Are you buying an apartment? Are you buying a house, standalone house? And are you buying in Dunedin or are you buying in Hamilton? Then, of course, you've got your cash flow costs, so how much it's actually going to cost you on a per week basis to own that property once your rents come in and you've paid all the bills. And then your third cost is your setup costs, so all the things that it's going to cost you to buy this property and get it set up correctly as a rental property.
And I think those setup costs are one in particular that a lot of property investors forget about. So let's start by diving into what it actually costs to buy a property. Now, it's a bit different whether you're investing in a new build or an existing property. Let's start with new builds. The cheapest you're probably going to buy is going to be a 2-bedroom townhouse, and that's going to be the likes of Christchurch. Usually, what's that going to cost, Andrew?
550, 600, 550, 560.
Yeah, about $550,000, $560,000. Now, that's going to go up depending on how many bedrooms it has. So if a 2-bedroom townhouse in Christchurch costs 550, 560, you're probably looking at closer to 660 up to 700K if you're talking about a 3-bedroom townhouse. And of course, it goes up a little bit more again if you're thinking about a 4-bedroom townhouse, which might be in that mid 700K range. Now, if you go to somewhere like Auckland is a more expensive city, and so property prices are naturally going to be higher. So a 2-bedroom townhouse there might be, say, 700K.
Yeah, 700 would be kind of entry level.
That'd be the minimum. And then it would go up to maybe 760K.
Maybe 800 if it was a really nice area.
So if you're talking about an Auckland 2-bed townhouse is going to be 700 to 800K, and in Christchurch it's around that 550K mark. So, there can be about $150,000 difference if you're investing in Auckland compared to if you're investing in Christchurch. And then, of course, property prices in Auckland, the sky's the limit in terms of what you're going to pay. But generally, you wouldn't see an investor who's purchasing a new build spend much more than about 1.1.
Certainly, I wouldn't recommend that.
Yeah, typically around that 1.1 before the yield starts to become really low and probably just not worth it. So you're probably looking at spending somewhere between 550K and then up to 1.1 mil if you're investing in a new build around New Zealand. Now, it's a bit different if you're investing in an existing property. Now, with existing properties, the property price will be cheaper, but you are going to pay twice the deposit, remember, because they require about 35% deposit, 40% deposit, depending on when you're listening to this and what the LVR is at that specific date, because it is changing in a couple of weeks. But they are often cheaper. So an existing property in New Plymouth or Whangarei might start around that 400 to 450K mark if you're at the really cheap end, and then you're going to need some renovation costs as well, but we'll talk about those in a second. But I tell you what, we are going to do a whole episode in about a week's time on the factors that increase or decrease the price of a property.
And look, one thing to remember is that doesn't have to come from your own pocket. So saying, you can buy something for this level doesn't necessarily mean that you need to have 600,000 in the bank, because not many investors I meet have 600,000 sitting in the bank to buy an investment property. Most of the time you can use your house or other investments to leverage you into that by borrowing the deposit against that property and then more against the investment property. But I won't go into that. We've got lots of episodes on that.
Yeah, so most of the time, you're going to be borrowing all of the money for the purchase price for the property. And that actually leads us into cash flow, because a lot of investors are surprised that they are going to have to, especially at today's interest rates, put money to top up the mortgage because the rent doesn't cover all of the costs.
Yeah, and they don't have to. They've just got to have some cash if they want to put more of a deposit in. But if you are borrowing 100% of the purchase price, you will very likely, on today's interest rates, not have enough rent to cover all of the costs. So then the shortfall is sometimes called negative gearing or an investor top up or an investor contribution. That's the amount that you have to put towards the investment property. Now, just to give you an idea of what that might look like, if you're buying a new build at the moment at kind of the lower end of the spectrum, then you might be somewhere around that $300 a week top up that you need to make towards owning that property when borrowing 100%. If you're at the higher end, you're buying a bit more luxurious property in Auckland or a bigger property in Auckland at the upper end of that spectrum, then you're probably looking $500-600 a week top up.
And just to be really clear, this is every single week you're going to be transferring that money into the property's bank account to cover all of the costs.
Yeah, at least until interest rates come down a little bit. Now, we've talked previously on other episodes about the way to reduce your contribution, and the number one way of doing that is have more cash. So if you are the type of investor where you've got some cash in the bank, and I do work with a lot of investors like this as well. You know, an investor of mine at the moment, they've got $1 million that's invested in just term deposits at the moment. So what they're going to do is work out exactly how much they need to take out of that $1 million to get the property to a more manageable contribution. So there are plenty of investors out there with cash, so you can do that as well to bring down your weekly contributions. But this is more if you're borrowing 100%.
And the reason that happens, obviously, is the lower the mortgage, the lower interest cost you're going to have. And the mortgage, the cost of the mortgage, is the largest expense that a lot of property investors face. So naturally, if you have a bit of cash to put in as a deposit, then of course that will come down. But it all depends on how much you're actually borrowing. Now, cash flow is one of the main things people ask us about. So walk us through some examples of how the cash flow actually works today.
Okay, so I'll give you 3 examples. Let's say an Auckland property, 100% borrowing on an $830,000 purchase price, getting $700 a week rent. Let's say Christchurch at that lower range, $560,000 purchase price, getting $495 a week rent. And then I've got a property in Whangarei where the purchase price is $450, but the investor's putting in $65,000 as renovations to get the value up at $575 and a rental income of $650 a week.
Now, there's a lot of numbers in there, but all you need to know is we've got an Auckland new build, a Christchurch new build, and then a Whangarei renovation property. Now, talk to us about the sort of contribution per week the investor would have to put in to own these 3 different types of properties.
At the moment, with high interest rates, the Auckland property would require about a $500 a week top up in its worst year. Christchurch would require about $350 a week top up in its worst year, and Whangarei about $300 a week top up.
So the key thing there, your Auckland property was about that $500. Your Christchurch property was about $350 a week. And then the Whangarei property, about $300 a week. So these are the types of cash flow contributions that most investors would have to make if purchasing today and borrowing all of the money to invest. The last thing we need to talk about, of course, is your setup costs as well. Now, these could range a bit, but it usually costs about $4,000 to $7,000 in order to just purchase a property. And these are the costs of engaging people like your lawyers, your accountants, maybe a property inspector, those kinds of people. Now, often investors can pay for these in 3 different ways. Some investors actually borrow the money against their house to fund these setup costs. Other people might use a bank cashback. So when you go and buy a property, sign up a mortgage, I actually did this recently. I borrowed $500,000 and the bank put $5,000 in my bank account and I could spend that on whatever. I chose to use that on paying my lawyer and some of my setup costs. Or you might just have money in your bank account that you can put towards this, but you will need $4,000 to $7,000 in order to be able to actually buy the house. And it might not just be to pay your lawyer or a property inspector. If you are purchasing a property in a different city to where you live, you might have to spend some money on flights and potentially even accommodation to go fly there, see the property, if that's what you want to do. Now, you don't have to do that, but that's one thing that a lot of property investors will do. Now, in a previous YouTube video, I have actually gone into even more depth about this, which I think is called the 6 hidden costs of buying a property. And I actually give an example where it could be up to $12,000, but that would be in a very specific case where there's non-bank lender fees, flights and accommodation, those kinds of things.
And just remember that some of these costs are a little bit variable. So a lawyer, for example, might cost you between $2,500 and $3,500. Accounting fees might be nothing, but if you set up a company or a trust, they could be $2,000. If you're getting a chattel valuation, which we encourage, that's normally around $500. If you're getting a registered valuation, that could be anywhere between $700 and $1,000. If you're getting a building inspection done, which we'd recommend, that could be somewhere between $500 and $1,000. So all up, kind of around that $5,000 to $7,000, $8,000, of which you need to either pay for yourself or use the bank.
And on top of that, if you are going to invest in existing properties, you're going to need your renovation funds. Now, I include these within setup costs. Usually, if you're going to renovate a property, typically would suggest spending $60,000 to $80,000. $65,000 seems to be around about the sweet spot, depending, of course, what you're doing. So those are the three costs that you need to keep in mind. First, you're going to pay some money in order to actually purchase the property. Hey, I haven't surprised you there. You already knew about that. Cash flow is the second major one that people forget about. Your rent is unlikely to cover all of your costs, even if you renovate in today's market. And then the third thing that you've got to think about are those setup costs. So buying the property, $550K is kind of your minimum, $400K if you're doing an existing property and renovating. Your cash flow, somewhere between $300 and $500 a week. And your setup costs, about $4,000 to $7,000. Could be a little bit more, could be a little bit less. Now, Andrew, given all of these costs, what advice would you give to somebody who's considering investing in property?
I think the number one thing is to know your numbers and to run your numbers on any property that you're looking at buying, so you know what you're going to be up for in your specific case. The other part, I think you need to be prepared mentally to actually contribute towards an investment. So don't go into buying an investment property and think, I'm going to not make any contributions. I think that's just unrealistic most of the time now with today's interest rates. So be prepared to make some sacrifices in your personal budget to be able to afford that. And probably the third bit of advice, start now. So even if you're not buying a property today, start putting aside $300 a week if you're going to buy at the lower end, or $500 a week if you're going to buy in Auckland, because that way you're getting into the habit of making a contribution now. Even if you don't end up buying a property right away, you're just going to build a bit of a buffer.
And I think when investors run their numbers, and of course you can download our spreadsheet, it's completely free, opuspartners.co.nz/ROI, you'll notice that the amount of money you have to contribute or top up the property by, it goes down over time as interest rates normalize and as your rent increases. So I think that it's not $350 or $500 a week forever. It's for a short time while interest rates are high. But you can test out different assumptions about what you think interest rates are going to do within your cash flow modeling. Right, let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you've got a friend who's thinking about investing in property, you might like to share this episode with them so that they can understand these three costs. That is the main way that people find out about the show. And I know a lot of you guys who listen, that's how you found out about it as well. Thanks for listening to the Property Academy podcast. I'm your host, Tim McKnight.
I'm Andrew Nicol.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time,